And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the show today. Of course, it's Monday as we kick off this Mother's Day week. That's right. Don't forget this weekend. It's the big one. Most celebrated holiday of the year next to Christmas. So don't forget Mother. Do you know Mother's Day has the least amount of crime in it? Yeah. So one of the lowest crime days of the year is Mother's Day. All the criminals off the street celebrating Mom.
Or Mother's off the street.
Maybe either way. So anyway, don't forget Mom. She's right around the corner, and so that's coming up really quick, and so don't want to sneak up on you. So a couple of things over the, last week. Obviously, the big news was the FOMC meeting. Jerome Powell talking about cutting QT a little bit more than expected, and that really kind of gave the bulls a lift on Friday. We're going to talk about that a bit more today. Now, normally I publish a Tuesday take, kind of which is market-centric, etc. It's published today on the website. So if you go to the website, realinvestmentadvice.com, tomorrow's article is actually being published today. And the reason is that we're going to lay out in that article 3 different pathways for this market over the next few weeks. And so it's kind of, you know, it's all based on the close from Friday. So what happens today in the market is going to start kind of moving towards one of those 3 paths. So that article is now published on the website right now. So if you go to the website, realinvestmentadvice.com, articles there in the blog section. So just you can download all the charts and graphs that go along with it. We'll touch on it a bit this morning during the show. We're also going to talk a little bit about stagflation, a lot of erroneous information about people thinking we have stagflation. So we'll kind of get into that detail a little bit more this morning. But outside of that, you know, the FOMC's talk about cutting QT. That's going to add liquidity back to the markets. That kind of got markets excited on Friday. Also started pulling off some of the bond yields. Bond yields came down with that news as well. Bond prices up. Because again, this brings a buyer potentially back into the market. So if you don't understand QT, let me explain it really quick. So the Fed was doing quantitative easing previously, and that's where they were out aggressively buying bonds. So a bank would own a 10-year Treasury bond. They'd own $1 billion of it. The bank, the Federal Reserve would credit the bank's reserve account with digital ones and zeros, and this is why it never caused inflation, because there was not an actual movement of money. It was just a credit to a reserve account, and the bond would move from the bank to the Fed. The Fed did not buy treasuries from the Treasury. They bought treasuries from the banks, and that was QE. QT was basically reducing the size of that balance sheet, and they were doing that by letting bonds mature. So their goal was to do $65 billion a month in Treasury bonds, another $30 billion a month in mortgage-backed securities. That was $95 billion altogether. And what would happen is if you had $100 billion worth of maturities, they would buy $35 billion worth of treasuries. So this is why people are like, well, I don't understand why they're still buying bonds. Well, because they're just letting it mature at this rate. So as bonds mature, they just let them roll off the balance sheet. They don't replace them. They replace what they needed to. So now they're going to reduce that, which means that they're now going to be letting only $25 billion of bonds roll off their balance sheet, which means if 50 roll off in a month, they're going to have to buy $25 billion worth of bonds from the market. So this is going to improve bank reserves because they will credit the bank reserve account and then they will buy the bonds from the banks. This provides another buyer for bonds in the overall market. That's why bond yields fell on Friday. So again, this just provides another source of bond buying in the markets and returns that. So again, eventually when QT ends and the next QE begins, then this process will reverse. That's also going to coincide, obviously, with a drop in interest rates, also providing liquidity to the markets as well, because obviously it reduces overall financing costs. So that's why the markets like that data on Friday. And on Friday, we rallied and tested the 50-day moving average, which is where we start the trading day today, and why I posted tomorrow's article today, because it picks up right here at this juncture. So again, that's kind of where we are. Again, we'll get into that a little bit more this morning and why the bulls kind of have a little bit of a bias at this short-term kind of juncture as well. But here's what you need to know before the bell this morning. Let's just go through the rub of it very quick. We are right at that 50-day moving average. So this is critical resistance here. The market's kind of at a make or break juncture at this 50-day moving average. If we can break above this moving average today and close above it and hold above it here this week, we're going to try to retest these previous highs of the market. So again, upside is around to 5,200 right now for the markets. And again, as we kind of wrapping up earnings season, we have about 80% of the S&P now behind us in terms of reporting earnings. Earnings beats were kind of not great. We had a very low beat rate actually in terms of overall earnings, but the majority of earnings growth came from the big mega cap companies. For everybody else, really not a lot of earnings growth. We saw a lot of misses, a lot of stocks down, 15, 20%. Earnings misses were brutally punished in this market this year. Rewards were not that great if you actually beat earnings for some companies. So anyway, we're right here at the 50-day moving average. We're now back on a MACD buy signal as well. So we now have this kind of support for the market. You've got a MACD buy signal. We're not overbought yet. So again, the kind of the pressure at the moment is to the upside here. And again, with the Fed becoming a little bit more dovish for the markets, that's been giving the bulls a little bit of support here. We have a lot of economic data out this week also, so we'll see how that data kind of supports this move in the market. But for right now, depending on how we finish the day, the bias is to the upside at the moment. If we can close above this 50-day. Now, right now, futures are currently pointing higher. We're up about 136 points on the Dow at the open, about 30 points on the S&P. So again, kind of looking at implied open on the S&P right now is 1796. So up about 18 points. My apologies, about 130 points for the Dow. So again, certainly looking to break above this 50-day moving average today. And again, that'll kind of break that overhead resistance that provided that first failure. So back about last week, we tried to get to the 50-day moving average, and that failed, and my monitor's frozen this morning, so I apologize. But we failed right at the 50-day moving average, tested the 100. So that was the first kind of test at resistance. We're now doing the second test here. This is why this is kind of make or break. The market can break above that level. We're going to get a move higher. So at least in the short term. Outside of that, again, there's not a lot of issues at the moment that are really kind of weighing on the markets. If we take a look at, kind of the overall sentiment, yes, I know there's a lot of people very concerned about, hey, we're going to have, we're still supposed to have a recession. We're supposed to have these other things. This is what's happening with the yen. This is happening with geopolitical events, et cetera. And this is all going to mean that the markets are going to crash. This doesn't really work that way. So, but again, paying to the markets attention to the markets here in the near term, the bias is to the upside at the moment. And again, just continue to kind of trade that way until the market gives you a reason. And what reason would that be? Well, if we break below this 100-day moving average, now we got something to talk about, probably a bigger decline. Also, we just had a fairly weak April. May tends to not be a hugely positive month, but tends to be a little bit lackluster. But June, July, and August, as we've said before, tend to be fairly strong months in presidential election years. We're still set up for another correction here. We get a rally. We have another correction coming potentially in September, October, right before the election. So again, just because the bulls kind of have the narrative at the moment doesn't mean they're going to keep it that way for the rest of this year. We've got another potential correction ahead of what's going to be potentially a fairly contentious election. So we'll talk more about this and the drivers for the markets. Also talk a little bit about stagflation this morning. It's all coming up on the Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire,
But are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Nothing's working this morning. So, just talking a little bit before the break here about this kind of stock rally, and there's basically at this moment about 3 pathways for this market to go, and we'll talk a little bit about that here in a second. But this is the big issue right now, which is all about liquidity, and this is why the markets kind of got so excited on Friday in terms of liquidity and what's going on, because so when we have a liquidity index, which is the Fed balance sheet less the Treasury General account, less the reverse repo. Well, reverse repo is going away, right? That's going to go to zero at some point here. That was an emergency funding program set up really in 2019 and then went into overdrive in 2020 with the shutdown of the economy. That's now working its way backwards, and we're slowly draining that reverse repo program, and that will eventually go away. So that part of liquidity will end. The TGA account, that's Treasury General account, there was a big drop in liquidity because there was a big jump. So again, we subtract the TGA from the Fed balance sheet to look at overall liquidity. Well, there was a big jump in the TGA balances because of tax collections. So that means that the Treasury will have to issue less debt in the coming months, about $103 billion worth of less debt. So that's going to be, that reduced overall liquidity because now the Treasury is sitting on a bunch of cash that'll now get distributed back out into the economy as the government goes through its normal spending process. However, again, if we slow the rate of reduction in the Fed's balance sheet, that's going to supply liquidity to the market because now the Fed's balance sheet, right, that's the first ingredient of liquidity, is not going down as fast. So that's going to increase, and that's why the markets like this news, because this will add liquidity back into the financial markets. And again, we know this because, again, if we look at the Fed's balance sheet, it's been following its taper program almost to a T. And the projection now at $25 billion a month starting in June will start to kind of begin to very slowly start to kind of flatten that out a little bit. I mean, we're still reducing the balance sheet overall between Treasury, mortgage-backed securities, and Treasuries to tune to $55 billion a month. So again, we're still reducing it. It's just not reducing as much and as rapidly. But the trend is clearly there. And of course, that is a function of providing that liquidity back to bank reserves. Because again, when the Federal Reserve buys bonds, they buy them from the banks, and then they credit the bank reserves of the banks. The banks then loan that money to hedge funds, their prop desk, et cetera, which finds its way back into the market. So again, if bank reserves start to increase, that's going to start supporting the markets as well. So again, this is all about liquidity at the end of the day, and why the markets liked this news from the Fed on Friday. And so if we take a look at the markets, as I was saying, we were right there, at that 50-day moving average as of Friday's close, and we were coming off support. We tested the 100-day moving average twice. We're now set with this buy signal potentially for the markets to move above that 50-day moving average today. So this really kind of lays out three different paths for the markets from here, things that can happen. Right now, with the way it's looking, as I wrote this article over the weekend, I said, well, path A is if the market moves above the 50-day moving average and we go retest previous highs. That's probably the most probable event right now because of where we are in the markets. A fairly possible event is that we open up today and then fail, and the market sell off. Very possible today. And if we fail again at the 50-day moving average, we're going to wind up testing the 100-day moving average, which is that path B. And that's a very possible outcome, right? So we have probable, possible. The least possible right now anyway is a violation of the 100-day moving average that takes us down to the 200-day moving average, that kind of that 10% reversion. It's certainly possible, but out of the three scenarios is probably the least of an issue right now, just because of the underlying kind of dynamics of the markets. And the reason is there's no stress in the markets really whatsoever. I mean, this recent correction did not see volatility increase much at all. We saw volatility tick up a little bit, but nothing abnormal, and certainly no sign of real stress coming from the volatility index. And more importantly, as opposed to last summer when we had that 10% correction, we did see credit spreads start to rise a bit. And that's not been the case this time. And so, we've not had any real sign of credit stress, between junk bonds and AAA rated bonds. So again, those credit spreads continue to decline. They're below the long-term average. Certainly doesn't suggest there's any real kind of, concern or crisis situation in the markets that would suggest a bigger decline here in the short term. This doesn't mean this can't happen in the future. We're just talking about over the next few days, few weeks. More importantly, no credit stress, no volatility, and buybacks open back up starting this week. So we are at the tail end of buybacks, and of course, Apple's announced $110 billion, Google another $70 billion. That's on top of the $1 trillion that was already slated for this year. So just a rising number of buybacks on coming back into the markets, and those have been a primary supporter of asset prices, of course, over the last decade in particular. And that option opens up, and so we'll have May, June, July, right, of buybacks before the blackout window comes back again, and then we have September, October potentially, where you kind of get those pre-election jitters. And again, there's no guarantee of this, right, that we'll have a sell-off in September, October. It's just historically kind of what happens in election years, because Wall Street kind of doesn't know who's going to win the election for sure. And this year, probably more so than anything else, is who's going to win and what's those policies going to look like. So again, a little bit of de-risking ahead of the election certainly seems possible, right? But anything can happen. So we'll see. But right now, there's a lot of concerns that this market is going to have a bigger correction and we got more to go. And maybe, right? I mean, there's no guarantee that we're out of the woods just yet in this particular little correction. Back in, March, we were talking about, hey, we're going to have a 5 to 10% correction. Well, we had a 5.5% correction. So well within the context of norms. We're getting through earnings season. The buyback window's opening back up. So you have a lot of support for the markets coming back in. Doesn't mean we can't have a bigger correction. So those of you that are wanting a bigger correction, it can happen. I'm not saying it can't. I'm just saying the odds are starting to weigh out. And particularly with today's trading, we'll start to kind of weigh out towards more of the bullish side of the ledger at the moment. Again, that's just kind of what market dynamics look like at the moment. And again, I don't want to dissuade you from whatever you're doing. Things can certainly happen, but these are just kind of where we are in the market at the moment. And this is part of the article I wrote on Friday, and it was interesting because I wrote this article on Friday talking about biases and the things that are impacting portfolio performance, because I'm getting a ton of emails from you guys that are just super bearish, right? And inflation's going to go to the moon, and there's nothing's going to stop it, and all these type of things. Hey, I get it, right? These are great headlines, and in particular to inflation, it's I got an email from a guy. He's like, well, if you look at inflation based on the way we used to calculate it, we've got double-digit inflation. Well, yeah, maybe, but we don't calculate inflation that way anymore. And that's where we're starting to seek out data to confirm a bias, right? That's confirmation bias. That's the number one reason why investors underperform over time. We're just seeking out whatever information confirms what we're looking for. That's what we're going to use. So let's go pick a measure of inflation that nobody uses anymore, and say, well, there's the real inflation. Well, maybe, but the markets don't care about that. What the markets care about is the government data. That's what they operate on. You can come up with any measure of data that you want, and it's fine if it confirms your bias, but if the markets don't care about it, it's not going to matter. So again, this is why it's important. Yeah, we may not agree with these measures of inflation or whatever it is, employment numbers. We don't agree with them, right? They're completely bogus. Maybe. And that's okay, right? I'm not just sure those employment numbers are jiving with reality either, but it doesn't matter because that's what the market looks at. So again, we have to remember the difference between what we think about things, right, and what we observe, right? We observe things with our friends and our neighbors and what's going on in the economy, the price of food, the price of eggs, the price of gas. We observe that. That's our reality. But we can't invest based on our personal realities because that's not what the markets care about. The markets only care about what the government data says. And that's a hard thing to kind of wrap your head around because the government data is wrong. That's eventually going to show up in the markets. Yeah, but it'll show up in the markets when the data from the government starts to reverse. It's not going to do it before. And so this is the challenge we have as investors. So I wrote this article on Friday talking about, psychological biases, confirmation bias, herd bias, gambler's fallacy, those type of things. So go to the website if you want to read it, see how many of those that you have. We all have them, by the way. I have them. Everybody has them. But it's on the website now, realinvestmentadvice.com. We'll come back, talk a little bit about stagflation. Do we actually have stagflation? Is it a thing? We'll talk about that right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Gen Zs are now rediscovering old stuff.
Yeah.
Camcorders and flip phones. See, I think Apple's missing it. They need to come out with a flip phone.
That would be brilliant.
Yeah. When you flip open the phone, it plays 90s music. They're rediscovering 90s music.
The Real Investment Show podcast. Same show, your schedule.
They're not discovering good music, right? They need to go back 10 more years, get to the 80s.
At realinvestmentadvice.com.
Get to some good music.
70s.
No, not the 70s, Brent. 80s.
I'm with you, Brent.
60s.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome to the show, or back to the show, rather. Here it is Monday, so we kind of get this week underway. Very interesting today, a company called Hims, H-I-M-S, is called Hims and Hers, and they provide products for male and female hair growth and sexual performance and all this type of stuff, right? So there's a couple of these companies out there like that. It's, Hims, and there's one called Shapiro MD, some others. And they're out there to provide, these products to enhance your life a bit, more than one way, I guess. But to make your life better, right? You want to live better, look better, feel better, right? Interestingly enough, one of our favorite companies in our portfolio is AbbVie, which is the maker of Botox. And I made a comment on the show the other day that my wife keeps AbbVie in business, and that's not really true, but she gets her lips done every now and then, and she's a very lovely woman, and she's determined to age gracefully, right? And so she's like, beauty is pain, I've got to do the work. And but it was interesting because it's not women of her age that are driving the trend in cosmetic fixes, right? And I'm not talking about plastic surgery so much. There is that going on as well. There's plastic surgeons are reporting a big jump in the number of people requesting plastic surgery as well, but not in the Gen X group. It's in the Gen Zs. A big jump in Gen Zers that are wanting, lip injections, Botox, fillers, those type of things, so they can take better selfies. They want to look better when they take a selfie, right? Because there's all this competition, right? So, they've got all these filters now on social media, so you can take out the wrinkles, make yourself look 10 years younger. Obviously, we don't use anything here on this show. Maybe we should, but the Gen Z group, that younger age group, is now opting for a lot more medical enhancements for better selfies. So that's helped support a company like AbbVie. Again, one of our favorite stocks. We've owned it forever. And we'll probably own it forever because of stuff just like this. Anyway, I just thought that was funny. So talking a little bit about stagflation here just for the break and kind of what's going on. There's a lot, I'm getting just a ton of emails about, we have stagflation. This is like the 70s. And I don't think anybody really understands what stagflation is. I think a lot of people make up definitions for stagflation because, again, there's a very specific definition of stagflation. And if you look at the definition of stagflation, it would tell you we don't have it. But again, people look at, we have inflation and economic growth, so that's stagflation. That's not stagflation. Inflation tracks economic growth. It's supply and demand. If you have economic growth, you have demand. If you have demand, prices go up. And there's a very high correlation between inflation and GDP over time. All right, back in the 70s, we had very high rates of inflation. You also had 8 to 9 to 10% rates of economic growth, as high as 15 on a nominal basis in the 70s. So if you have very strong economic growth, you're going to have higher prices, which is higher inflation, right? But what the definition of stagflation is high inflation, low economic growth, and high unemployment. That's the definition of stagflation. And if you go on to Google right now and search the number of people that are searching for stagflation, we've had a very big spike. And in a minute, Brent's going to stop playing around behind the desk and he'll actually put the chart up on the screen. Apparently, we have stagflation in his paycheck. So
I was listening for your usual cue. As you can see by this chart, ...
My way was better. But as you can see by this chart,
thank you.
We have stagflation according to the number of people searching for it, right? So we have a very big surge in people all of a sudden going, oh my gosh, stagflation. And this has come from some of the recent economic reports that we had in terms of the PCE price index, the employment cost index led to this big jump in this search for stagflation. And it's not surprising, right? I mean, again, we just kind of look for things that go on. But let's talk about do we have stagflation, right? Do we have it? So again, we have, as you can see by this chart, we have a formula, right? Weak GDP growth plus high inflation plus high unemployment is equal to stagflation. Well, right now, we obviously don't have high unemployment. We have near record low unemployment. So we don't have high unemployment. So that's out. Inflation has fallen from 9% to 3.25%. So that's really about average inflation going back to, 1947. It's a little bit higher than average, but not tremendously higher than average. So we really don't have high inflation to speak of. And we really have decently strong nominal economic growth. So we don't have low economic growth on a nominal basis. And and we use nominal GDP when looking at this, right? Go back to the 70s and there was a brief moment that you had stagflation and then it went away. But most of that, and that was because of a big recession that we had back in the 70s, but during the 60s and the 70s, you had very high rates of economic growth, which is why you had rising inflation and which you had rising employment. So, you had all the reasons in the 60s and 70s was very strong economic growth, which is why you had higher rates of inflation. And again, inflation tracks economic growth, just the way it works. So again, if you just take a look at the current data, we really don't have stagflation. And doesn't mean we can't get it at some point. I'm not saying that. But there's a lot of concern about it right now, obviously. It's all the headlines. People are, and again, it's like, I don't want to be in stocks because of stagflation. It's like, we don't have it right now. The reason that everybody got all excited was taking a look at the GDP versus the PCE price index that came out just recently. So GDP fell to 1.6 on a real basis, not nominal, real. And the PCE price index ticked up. And so immediately everybody was like, you saw that chart on people searching for stagflation. It's stagflation. Well, no, you still don't have high unemployment. So even if you want to use this measure and say, okay, that's stagflation, it's not, because you don't have high unemployment. But what everybody forgot was, see that massive drop you had in the PCE price index in the prior 2 quarters? Yeah, that just kind of completely just flew past everybody. And it's like, okay, so you just had an uptick for 1 quarter. And what happens in the first quarter of every year? This happens in the PCE price index. You have adjustments, and then when we get to ECI, we'll talk about that in a second. But you have things that occur in the first quarter of every year that are seasonal, and they're one-time events, and they go away. But importantly, the PCE price index is very volatile. It's all over the place. It's up, it's down, it's up, it's down, it's up. And every quarter, it's up or down, right? So to get a better view of the PCE price index, we need to take a look at it and smooth it out a bit. And so we'll just use a 1-year average of the PCE price index just to smooth it. And when we do that, we find that it has a very high correlation with GDP, with inflation, with everything else. And it's not really rising. It's actually falling along with CPI and along with economic growth, which is exactly what you should expect. Economic growth is slowing because all that monetary impulse is coming out of the system. So GDP is slowing, inflation is declining, so is the PCE price index, supply and demand. It's basic economics. And so if we take a look at GDP versus PCE versus CPI, this is actual personal consumption expenditures, there's an extremely high correlation between PCE and GDP because PCE is 70% of GDP. So it's undetectable that there's a difference. Those are all declining right now because the economy is slowing down and will continue to slow as we get further into the year. Again, this isn't necessarily recessionary. It just means it's slowing down. It's returning to normal. We're going to get back to that 2% economic growth. Inflation will fall to 2% ultimately because it is going to track economic growth. ECI was a similar story. ECI is the employment cost index. And everybody jumped on the ECI index and says, oh, see, stagflation. There's evidence, right? Employment costs are going up. Yes, there was a big jump in the employment cost index. Why? Because it's the first quarter of the year. What happens in the first quarter of the year? Everybody gets bonuses, raises, distributions, cost of living increases. Your insurance goes up at the beginning of the year because it resets at the end of the year. So I have open enrollment in October, November, and then you get your new insurance plan. Your cost goes up. That all reflects in quarter one. Again, if we smooth that, we find basically that it's declining as well and continuing to decline. And it will track GDP because, again, these are all functions, part and parcel of the same thing. When you take a look at the overall economy, it is slowing down and it will continue to slow down unless we have another big spending bill. If for some reason the government's able to come out and pass some other major spending bill that's going to inject massive, trillions of dollars into the economy, then yeah, we're going to have another bout of inflation. If it's directed to households. If it's just non-productive spending, we're not. All right, quick break. We're going to come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, interesting, I'm reading your chat over the break, by the way. And no, I'm not giving Brent a raise. He already got one this year. So I take very good care of Brent because we can't do the show without him. So he has all the power. He's like my wife. He has all the power. We just don't tell him, right? So we just let him think he's actually is an employee and not an owner. But anyway, reading the chat here, you cannot double count inflation, and so our chat here is from David because he's got a capital A in David. I don't know. Anyway, David, you cannot double count inflation. GDP at 1 point. So he wrote that GDP is 1.6 and inflation's 3.5. Lance is giving us alternative facts. No, you cannot double count inflation. Inflation was 3.5. GDP was 5.1. That's fairly strong economic growth at 5.1%. You can't subtract inflation from GDP and then count it twice. Right? So real GDP was 1.6. That's going to get revised up, by the way. And real GDP is tracking for Q2 at near 4% right now. We'll see if that comes down, but it's tracking at 4 at the moment. But that's the whole point, right? We want to come up with all these different reasons and rationales to help support a narrative of whatever it is. And this is, yes, Larry, I read your chat too. And some of these are going to get you banned. I have been known to ban people on this chat from time to time that say things. So just beware. Control your chat. Rich and Danny will let y'all get away with anything. I don't. So, but anyway, you can't double count inflation, and you have to keep things in perspective with what's going on. Now, I did say before the break that, could we have another big bout of inflation if we do another round of massive government spending? Yes, as long as that spending goes back directly to households or is productive in some manner, like the CHIPS Act, where you're actually injecting capital to build plants, right? So that's productive. That creates jobs. That puts things to work. That puts demand on commodities. That's economic demand. So that's going to create higher prices. But if we continue to just issue more and more debt to fund, Social Security, welfare, kind of just government spending programs in general, those are non-productive. That increase in debt leads to lower rates of economic growth. And again, this is a massive difference. Let's go back and look at real quick. So I got this chart of the 70s. So let's go back and look at the 70s here real quick and just talk about the 70s for a moment. So this is that 70s show. And we had multiple bouts of inflation. The Fed hiked rates multiple times, and then they had to cut rates because everything was reversed, went through bear markets, went through recessions, et cetera. And whenever you had a big bout of inflation, it was quickly resolved by the recession, right? Because all of a sudden you have this big spurt of inflationary pressure on the economy. People contracted spending, had a recession, it reversed. And then you had the oil embargo, which was a temporary event. But overall, during that period of time, as inflation rose and as interest rates were rising, it was because you had much stronger rates of economic growth. And most importantly, you had very little debt. And I don't know if you can get this chart, or you have to make it do one chart. Do the left chart, Brent. The income exceeds in the 70s. So let's take a look at the 70s first. And what was important is in the 70s is that incomes exceeded debt. So people have more money to spend. So this is why you had very strong economic growth. So, I don't know about you, but I remember my parents, they did not have a credit card. That was non-existent. They had a checking account at the bank, and they wrote checks for everything they did, right? Or paid cash. That was it. There was no credit in the house. The only debt they had was their house. And that was the way it was for most families back in the 60s and the 70s. And so the incomes exceeded the debt. The federal government had no deficit. We didn't have that much debt to speak of. And so economic growth basically went right to creating economic prosperity, right? Activity in the economy, manufacturing, et cetera. Then, and by the way, household debt to income ratios back in the 60s, 70s was about 60% of debt to incomes, net worth, right? So let's flash forward. Now let's do the other chart, Brent. Starting in the 80s, right? This is where we deregulated the financial industry. Banks went, hey, let's give everybody a credit card. Tell them how it's great to be, how great it is to be in debt and all these things you can do being in, getting on credit cards. Let's send a credit card to everybody. Well, now debt vastly exceeds incomes. So it requires more and more debt just to sustain the current lifestyle. So the important thing about that is that the current economy can't really maintain higher interest rates and higher inflation for very long without having direct injections of capital to the household. Again, why are we where we are is because we sent checks to households. That's working its way through the system. Plus, we, told people they didn't have to pay their mortgage payment, they didn't have to pay their rent, they didn't have to pay their college dues, they didn't have to pay anything, right? We just gave everybody a lot of money. That's all working backwards now, slowly. But that money's coming out of the system. So this is going to have implications going forward because if you take a look at the debt required to sustain a household, right now it requires about $4,400 a year just to maintain the current standard of living for 80% of Americans. The cost of maintaining that is absorbing all of their savings, all of their income, plus they're going into debt. And so therefore, if rates go up, it costs them even more, pushes them further into debt until the whole thing kind of buckles. And so this is why when you start talking about the overall economy, and you look back historically, the reason that we have very low rates of economic growth and inflation outside of this abnormality we've got going on right now, and we will go back to having low inflation, is because of the debt. And this is why the Fed is now starting to reverse QT. So they can monetize more of the debt issuance. And that's not inflationary, that's deflationary. They have to bring yields down. They have to bring interest costs down in order for the economy to function. We cannot sustain higher rates with the amount of debt that we have because you just can't grow the economy. People can't take on the debt. It diverts too much of productive income into interest service expense, both for households and for the government. So those rates have to come down. That's why the Fed is going to do a reduction in QT, why they will eventually get back to QE, and why they will eventually cut rates, starting probably as soon as July, maybe September at the latest, and why they will eventually be back towards zero by 2025, 2026. We have to have that suppression of rates. And if you want a good example of this, go look at Japan. They're about 20 years advanced from where we are right now. And it doesn't matter what they do, inflation remains at zero. They just went in a recession, and interest rates are near zero. They're doing everything they can to try to keep interest rates from being negative. It's just a function of the debt. That's it. So the problem with all this is that it's not stagflation that is an issue. Deflation is the big risk because of the debt. I mean, look, y'all all focus on this, right? I mean, I read your chat. Y'all talk about the debt all the time. The debt is the problem. Absolutely. But debt is deflationary. It's not inflationary unless that debt is used to send checks directly to households where it gets spent in the economy. People go out and they buy stuff. They go on trips. They buy a new boat, whatever it is. That creates economic activity. Economic activity creates inflation. I was doing an interview with Adam Taggart over the weekend. He was talking about, companies are price gouging us. And it's like, no, they're not. They're just able to pass on costs because you're willing to pay it. And if you want to try to control that, that's socialism or communism, because you're going to put on price controls, which is not what you want. Consumers have the power to bring down inflation faster. They just have to stop buying stuff. But again, it's about convenience. We want what we want. We're going to go figure out a way to buy it. But again, higher prices and higher interest rates will eventually create slower economic activity. And we saw that in some of these recent earnings reports, right? Starbucks, KFC, McDonald's, all reporting slower spending. And we'll probably continue to see that here for a while longer as that monetary impulse continues to leave the system. It's going to take a while. It's not going to happen overnight. But in the next couple of years, this is all going to continue just to grind its way slower because of the debt. And there's just no way around that. And especially not at the rate that we're currently issuing debt. And again, the problem is if somebody tries to fix that by cutting the amount of debt that we're issuing, less government spending is going to slow economic growth even faster. So there's really no way out of the trap. Just a function of time until you get there. The destination is the same. All right, wraps up the show for the day. Have a great day. And we'll be back tomorrow. We'll talk a little bit about where this market ends up today. So, do we get above, the 50-day moving average? We'll see. Talk about it tomorrow. Have a great day.